Here's a trade update on Starbucks. Josh initiated a position just a few weeks ago. Shares are down 10% in December, on pace to break a 5-month winning streak. But he says this could be an opportunity to add. Josh, coming over to you.
Yeah, so look, this stock was down 13% in 2022. It was down about 2% last year. And if it closed today for the year, it would be down about 2%. This stock being down 3 years in a row is a pretty rare thing. You don't really see that very often. And quite frankly, it's understandable why, but it's also understandable why things should be changing very quickly. They're going to report earnings on January 28th, so you don't have to wait a long time to see if the turnaround can be trusted. They're going to do $9 billion in revenue, which would be down 1% year over year. About $1.1 billion in EBIT, which would be down 23% year over year. So analysts' expectations are extremely low. The stock is effectively trading at its 10-year median valuation on all the important measures. And they just hired, arguably, the best living QSR industry CEO in Brian Niccol, who's going to turn this thing around. So I like the risk reward here. And if it gets into the low to mid 80s, I'm going to add an irresponsible amount of stock to my own portfolio. Because anytime Starbucks has been down, it's never been out. It's always been an opportunity. And I don't think that's changed this time.
All right, so stock's been pretty much flat since Niccol took over. We're just showing it up just about 1%. Is your confidence in the brand? Is it a Niccol? Is it a combination? I mean, what's given you so much confidence? Because we have seen a lot of competition. And in previous shows, I've seen you be very bullish on another name in that similar space, Dutch Brothers. They just face a lot of competition from a Dunkin' Donuts, from a McDonald's. There's just a lot of competition in the coffee space.
That'll never change. That's a permanent condition. When you sell food to humans, there's competition. So it's never been a reason to not be invested in Starbucks. Never been a good reason to be out of McDonald's. Like, competition is what forces these companies to innovate and get better. You don't want there to be no competition.
All right. Jenny, you have your own take on Josh's pick of Starbucks. By the way, shares up almost 0.5%.
So when I was a kid, my dad's favorite joke was, the fastest way to make $2 million in the restaurant business. Say what? He'd say start with $10 million. I think there is too much competition, and I think it's a little dicey. I think Starbucks is overpriced. The coffee's mediocre, depending on who you talk to. And I think the competition has really increased, Josh, in the last 10 years. So for me, it's a little rich. It's not where I want to play.
Is it simply just competition, or is there something else? I mean, the forward PE is relatively elevated, almost 30 times.
Let me give you this example. Last week, I was on the phone with the management team from Wendy's. We were looking at it for the dividend portfolio. And by the way, we're not going to add it. I'm not sure how committed to the dividend they are. Hopefully they are. We'll learn in March. Okay, but I'm on with Wendy's. You know what they're looking at? They're looking at coffee, because it's the highest margin, easiest way to expand. And they're talking about how well McDonald's has done with that, how Dunkin's coming back. Like, everyone wants to be in coffee because it's easy to add and it's high margin.
If you can go out on the street and find me one person, find me one person walking around with a straight face with a coffee cup from Wendy's saying that they used to go to Starbucks and now they do that. Find me one.
Okay, but you know what the point is? The point is that people used to get Starbucks.
Here.
Joshy, listen. The point is that they used to get Starbucks and now they have a McCafe. They used to get Starbucks and now they have a Dutch Bros. They used to get Starbucks and now they have a Le Pain Quotidien, right? It's the same as the athleisure space. It used to be just Lulu.
They said that 10 years ago with
Right, and look at what Starbucks has had a really tricky time.
And the coffee bean is always,
and it just keeps getting
Tim
tougher.
Hortons was gonna put them out of business.
I'm just saying.
It's always the same spiel. It's the names change.
But
it's always
real.
the same
I'm
story.
not saying they're going to be put out of business. I'm just saying the competition is real. The restaurant business is hard. There was a really great article, I think it was in the Times this morning, about TGIF. Like, TGIF used to be the be-all everything for fast dining, fast casual, right? Competition flooded that space. They're dying on the vine. It's a hard. Right. The restaurant business is a hard place to be
oranges.
in.
We got to move. We do have to move on very quickly. Kev, just take on Starbucks. Dividend 2.6%. Something you see opportunity there with the dividend basically 2.5.
We've owned it in the past. Certainly, there's a China overhang there. But to Josh's point, when you've got great management, you've got an opportunity for a turnaround.